Welcome to my channel. I'm Scott. In this video, I'm going to walk you through the process of valuing AstraZeneca stock so we can determine if it's a buy or a sell. AstraZeneca is a pharmaceutical and biotechnology company. It has a portfolio of products for major diseases in areas including oncology, cardiovascular, gastrointestinal, infection, neuroscience, respiratory, and inflammation. The company was founded through the merger of Swedish Astra AB and the British company Zeneca Group. The company is headquartered in Cambridge, UK and was founded in 1999. Let's get started with the model. This is a large cap company, 230 billion market cap. They're trading at $75 a share and they have 3.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grows a ton from $500 million to over $7 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also grows a lot from 1.2 billion to 3.3 billion. Revenue is a sales for the company and that nearly doubles from 24 billion to 44 billion. This is their most recent income statement from the first quarter of 2023 versus the first quarter of 2022. Total revenue is $11 billion. I'll give you a breakdown of that. Oncology is 4.1 billion. That's their biggest revenue generator. For CVRM, cardiovascular, renal, and metabolism, that's 2.6 billion. For respiratory and immunology, that's 1.6 billion. For vaccines and immune therapies, it's only 355 million. Rare diseases, 1.9 billion. And others, 320 million. The country with the most revenue is the US, 4.3 billion. China's 1.6 billion. Europe, 2.2 billion. Their cost of revenue is 1.9 billion. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's 9 billion, up from 8 billion. Their big operating expenses are R&D, 2.6 billion, and SG&A, 4 billion. So their operating profit is 2.5 billion, up a lot from 2022. And they had higher revenue in 2022. They're doing a great job at managing expenses. They paid 365 million of interest on their debt. So their net profit is 1.8 billion, up from 400 million. Let's look at the capital structure. 37 billion of equity, 29 billion of debt. They're 56% equity, 44% debt. Their net debt is 22.8 billion. So they have about 6.4 billion of cash on their balance sheet. I gave them a WACC of 7.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 180 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $164 billion. We divide that by 3.1 billion shares. And we get a calculated stock price of $53. They're trading at $75, so they're trading at a 42% premium. It's a sell according to the model. Simply Wall Street valuation is 84. They're saying they're 11.5% undervalued. Two analysts priced this stock and one is at 77, the other's at 85. This is where the stock has been trading the last 25 years. It broke through $30 for the first time in 2006. Then after the Great Recession, it dropped down to about $12 or $13. It never got up to 30 again until 2013. And then a few months later, it broke through $40. That was in the beginning of 2014. Then it took 6 years to hit $50. A few months to get to $60. And then it took 2 years from 2020 to 2022 to hit $70. Now it's pretty much trading at its all-time high. Since 2002, this stock is up 218%, while the S&P is up 250%. They pay a semi-annual dividend. In February, it was 99 cents. In August, it was 47 cents. That's a yield of 2.6%, which is 85% of their free cash flow, 186% of their net income. There are 15 companies in the same industry as AZN. And if they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend a lot less than most in CapEx. Their debt to equity is equal to the median. They have a lower yield than most companies in this industry. They don't really generate much free cash flow relative to their size. They rank 5th in market cap. Their price to book is a little worse than average. Their PE is a lot worse than average. Price to free cash flow is a good amount worse than average, and the price to sales is a little worse than average. Their revenue is the median, so they're right in the middle of the 15 companies. But that's not good because they're ranked 5th in market cap, but their revenue is ranked 8th. But the reason their stock is going up so much is because their 5-year annual revenue growth rate is 15%, a lot higher than the median and average. So to summarize, they've been around 24 years and they're growing at an amazing rate. 2022 was the best year ever for this company. And remember that term, the trend is your friend. So just keep rolling with it, because if it keeps going up, that's great. You just want to jump off before the ride ends. I ranked their free cash flows 9 out of 10, their revenue 9 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.